2.49%. That single number just sent shockwaves through the world's third-largest economy, and most investors have no idea what's coming next. Japan's long-term interest rates just hit their highest level since February 1999. That's 27 years. To put this in perspective, the last time rates were this high, Google didn't exist yet. The euro had just been introduced, and Japan was still recovering from its lost decade. Now here's why you should care, even if you've never bought a single Japanese asset in your life. Japan holds over $4 trillion in U.S. Treasury bonds. When Japanese interest rates rise, money starts flowing back home, and that creates ripple effects across every major market on the planet. Your 401k, your mortgage rates, the price you pay for a Toyota, all connected to what's happening in Tokyo's bond market right now. In this video, I'm going to show you 3 things. First, why tensions in the Middle East are suddenly making Japanese bonds move. Second, the hidden time bomb in Japan's debt that could explode if rates keep climbing. And third, what the Bank of Japan might do next, and how you can position yourself before the crowd catches on. This isn't just Japanese news. This is the canary in the global financial coal mine. To understand why this matters, you need to understand something about Japan that makes it completely unique among major economies. Japan's debt-to-GDP ratio stands at 263%. That's not a typo. For every dollar the Japanese economy produces, the government owes $2.63. It's the highest ratio of any developed nation on Earth, higher than Greece at its worst, higher than Italy, higher than anyone. For decades, this wasn't a problem. Why? Because interest rates were essentially zero. When you borrow trillions of dollars at 0% interest, the payments are manageable. The Japanese government was paying almost nothing to service this mountain of debt. But here's where the math gets terrifying. When interest rates rise, even by small amounts, the cost of servicing that debt explodes. We're not talking about linear increases. We're talking about exponential growth in interest payments. The trigger for this week's rate spike? Iran. As geopolitical tensions in the Middle East escalate, oil prices are rising. Japan imports virtually all of its oil. Higher oil prices mean higher inflation. And higher inflation means the Bank of Japan faces pressure to raise rates further. It's a chain reaction that started thousands of miles away but is now hitting Tokyo's bond market like a freight train. What this means is that ordinary Japanese families are about to feel serious pain. Mortgage rates in Japan are directly tied to long-term government bond yields. When the 10-year JGB rate rises, home loan costs follow within weeks. A 0.5% increase might not sound like much, but for a family with a 30-year mortgage on a Tokyo apartment, that translates to hundreds of dollars more per month. And it's not just homeowners. Japanese corporations have gorged on cheap debt for years, financing everything from factory expansions to stock buybacks with near-zero interest loans. As those loans come up for refinancing at higher rates, profit margins get squeezed. We're already seeing this play out in the stock market. The Nikkei has shown increased volatility as investors recalculate company valuations based on higher borrowing costs. Banks, ironically, might benefit. They can charge more for loans, but the broader corporate sector faces a reckoning. The yen is caught in the middle of all this. Higher interest rates typically strengthen a currency because foreign investors want to earn those higher yields. But if higher rates trigger an economic slowdown, that strength evaporates. Currency traders are watching every Bank of Japan statement like hawks, trying to predict which force will win. Here's what most analysts aren't talking about publicly. Japan's annual interest payments on its national debt are projected to hit 28 trillion yen this fiscal year. That's over $180 billion, just in interest. Not paying down the debt, just servicing it. And that projection was made when rates were lower. Every 0.1% increase adds billions more. But here's the real plot twist that should keep policymakers up at night. The Bank of Japan itself owns over 50% of all outstanding Japanese government bonds. They bought these bonds to keep rates low, essentially printing money to purchase government debt. It worked for years, but now they're trapped. If the BOJ sells bonds to reduce inflation, bond prices crash and rates spike even higher. If they keep buying, inflation gets worse. If they do nothing, the market forces their hand anyway. This is the monetary policy equivalent of being stuck between a rock and a hard place. Except the rock is a $4 trillion debt bomb, and the hard place is runaway inflation. No central bank in history has ever escaped this trap cleanly. The BOJ is writing the playbook in real time, and the entire global financial system is watching to see if they can pull off the impossible. So what happens next? Market watchers are already eyeing the 3% threshold. If 10-year JGB yields breach 3%, it would signal a fundamental regime change in Japanese monetary policy, the end of an era that defined global finance for a generation. Some analysts believe the Bank of Japan will be forced to intervene, using verbal guidance or direct market operations to cap yields. Others think Governor Ueda will let the market find its natural level, accepting short-term pain for long-term stability. What should you be watching? First, oil prices. If Iran tensions escalate further, expect more upward pressure on Japanese inflation and rates. Second, BOJ meeting statements. Any hint of yield curve control adjustments will move markets instantly. Third, the yen-dollar exchange rate. A strengthening yen despite rate hikes would suggest foreign investors are betting on Japanese economic resilience. For investors, this creates both risk and opportunity. Japanese bank stocks could outperform. Export-heavy companies might struggle with yen strength. And global bond markets may see spillover effects as Japanese capital repositions. The key is watching, not reacting emotionally. The smartest money is patient money. Let me leave you with 3 key takeaways from everything we've covered today. Number 1. Japan just experienced its highest interest rates in 27 years, driven by inflation fears linked to Middle East tensions. This isn't a one-day event. It's potentially the beginning of a fundamental shift in how the world's third-largest economy operates. Number 2. Japan's massive debt-to-GDP ratio of 263% means even small rate increases have enormous consequences. The Bank of Japan is navigating unprecedented challenges with no clear playbook. Number 3. This affects you even if you own 0 Japanese assets. Japan's position as the largest foreign holder of U.S. treasuries means Japanese monetary policy ripples through every major market globally. Here's your actionable takeaway. Add Japanese government bond yields to your watch list. When JGBs move, global markets follow. Understanding this connection gives you an edge that 99% of retail investors don't have. If this analysis helped you understand what's really happening in global markets, consider subscribing. We break down Japanese business news that mainstream media ignores, but smart investors need to know. I'll see you in the next one.